For a long time, 401ks were boring to invest, right? You had a limited menu of options. You really had traditional 401ks, so pre-tax contributions. There wasn't a lot of excitement around 401ks, but I would say like that's changed recently.
How so? What do you mean?
So, I mean, I think we see almost 100% of 401ks that come in, people showing us their statement, looking for advice, have Roth options now. In a lot of cases, they have after-tax investment options, which is a whole separate subject. But even more frequently, I see brokerage link options,
right?
Which where you can actually self-direct your 401k outside of that standard mutual fund chassis with a limited menu, and in some cases, invest in individual stocks, which I think really opens up the possibility. So I guess my point is, if you haven't looked at your 401k in a while, things may have changed. Mm-hmm. They're changing at a quick pace from when I started with Blue Chip 8 years ago to now. I see a lot more interesting options and availability within 401ks. And when I say 401ks, everybody should know we just mean workplace retirement plan. This can be 403b. The name can change, but think workplace retirement plan.
Yep, I'm glad you said that. Matt, let's peel that onion back just a little bit. So the traditional 401k plan or company retirement plan has some menu of limited investment options, right? So a lot of times that'll be mutual funds. So we generally don't see individual stock holdings within the menu of investment offerings. I think what most plans try to do is limit the number of available investment options to simplify what their participants get to choose from. Because if they have the universe of individual stocks or bonds or investment products to choose from, sometimes there's paralysis by analysis where they end up doing nothing. And so I think that was kind of the genesis of these target date funds, because it gives people they're mapped into it. And I want to go into target date funds as well, but it gives people an automatic default based on their age. So let's table that discussion for a second. But I want to go back to your earlier point. So the traditional platform has a limited number of mutual funds that are generally offered, and that could be 10 to sometimes maybe 30 different investment options to choose from. But you're saying there are also, you're seeing an emergence of companies that offer something called brokerage link or a self-directed brokerage account. And that's an offshoot of what the standard default menu is. And it allows the participant to go into the open market as an offshoot of their 401k and invest in virtually whatever they want: ETFs, mutual funds, stocks, bonds, other types of products. So it really expands the offering, but it takes the participant to initiate this link. It's not the standard offering to most employees. It's something that the participant, if they're looking for more than just the plain vanilla standard investment offering, they can go out and get a little more sophisticated.
So before we get too far into the weeds, I feel like it's a good idea to start high level and work our way down. So we talked about company retirement plans. You traditionally had your standard traditional pre-tax option, right? Mm-hmm. That's your standard 401k. As Matt noted, in recent years, the prominence of Roth 401ks has increased. So that's dollars that are put in after tax, and then later you're not taxed on them on withdrawals. So the first kind of layer really is vehicle structure. Whether it's a 401k, 403b, that's the first layer. After that, you start to get into, okay, within this vehicle structure, how is it actually allocated? And that's a lot of what you were just talking about. So maybe before we even talk about investment options and all that, what are the advantages and disadvantages of a traditional 401k versus a Roth? Like, who would use one or the other? Should you use both, right? Just some opinions there for, I would say, the average individual, I think is always good.
Yeah, I think it's a good place to start. Go ahead, Matt.
I mean, I think it always comes back to planning. I think conventional wisdom is that the person who makes a lot of money is going to get a larger benefit by doing pre-tax contributions, which is true. But in a lot of cases, with proper planning and depending on asset structure outside of the workplace retirement plan, you can find that person could be better off in the long run making Roth conversions or Roth contributions, Roth 401k contributions. So instead of taking the pre-tax deduction now, actually paying the tax today so they don't have to pay it later. And I say, again, counterintuitively, and this isn't a general recommendation, but just so people think outside the box. A lot of times people think when you're younger, you're starting off, you're in a lower tax bracket. It's great to contribute to the Roth. In some cases, it's worth bringing up scenarios where, hey, if more money can go in because you're deferring tax, that younger saver gets to see a bigger balance and the snowball compound and grow, and that creates some momentum and more incentive to save. So in a nutshell, the answer to your question is it depends. It's a conversation with the individual, and oftentimes it's a look deeper into a greater financial plan.
I think those are all great points. I would add that it's also a difficult analysis to really nail down because no one knows what future tax rates are going to what they'll look like down the road. And so I think most CPAs would argue, and this isn't, there's no right or wrong answer here, but they might advocate for pre-tax deferrals because we can guarantee that you're going to get the X benefit this year by making a pre-tax deferral. The benefits of a Roth account, a Roth 401k account, compounding and that snowball rolling for years or decades down the road has tremendous benefits, not only for the participant because Roth accounts don't require required minimum distributions. They also, can continue to compound after your death on a tax-free basis for your heirs. So there's a number of reasons to justify, regardless of the tax rates down the road, the benefits of Roth. But there's just different styles to advising clients. And I think the standard CPA would say, let's take what we can get this year. We don't necessarily know what the future has in store. So if we can get the tax deduction this year, let's take it. There's not a right and a wrong answer. There certainly, it could be a preference, not only by the client, but by also the advisor. So whether it's the financial advisor, the CPA. But I think, Matt, the first thing you said is it's all predicated on planning. And so instead of taking a dart and throwing it against the board and saying, I hope this works, with some intention, some thought, and some analysis, you can come to, I think, a reasonable approach or strategy that works for you.
Yeah, it's a holistic approach, right?
Yeah.
You don't want to just look at each account in isolation. You really want to combine everything and plan for the whole entire household.